right now we're in something of an interregnum in a variety of different respects. First of all, tariffs have been imposed by the United States unilaterally on others, and there's been a round of retaliations, which is to be expected in such situations, especially when global economic activity is as poor as it currently is. This was the pattern in the 1920s and 1930s. Ironically, the announcement of the tariffs has given the economy a boost in important ways. A lot of firms went out and ordered a lot of product from the rest of the world. Our imports had an unprecedented surge in the first quarter. That means that things like GDP and employment around the world were actually helped initially by the tariffs. And the announcement of tariffs caused consumers who are really in very poor financial shape, I would say wretched financial shape actually, they went out and they did a lot of buying in advance to protect themselves against the potential future price increases. We saw this in automobiles quite significantly. Huge surge in automobile spending started in the second half of March, carried over into the first half of April. We have anecdotal reports of it occurring in other areas, including iPhones. And there may have been in other items that were less widely followed that also benefited from this. And so when firms see a surge in the demand, they're going to have more folks on hand in terms of employment to handle it. But that surge in demand that benefited the world and also components of the U.S. economy, that's going to go away. So we're not going to have any data on that for a while. And so that leaves economists sort of in limbo. We've had an event, we've seen certain repercussions. One of the things that I think may have been overlooked is that while imports were surging and this benefit flowing to the rest of the world, the U.S. economy did accumulate a very substantial amount of inventory in the first quarter. And now firms have to move that inventory. And we'll see whether the consumer in a very emaciated state is in a position to do that. Another way in which we're in an interregnum is that we're experiencing a very significant drop currently for this current fiscal year, 2025, in federal spending. Now, part of the reason for the drop is that there was spending had a wild increase from October through January. Naturally, that kind of increase isn't going to be sustained, but more importantly, the budget that was enacted for 2025 is indicating that the increase in federal spending for the final 6 months of the current fiscal year, which started on the 1st of April, is going to be basically flat. So we're going from a massive federal stimulus to a zero federal stimulus on the spending side, a decline in real terms, and we don't have an offset in terms of where we're going with regard to federal taxes. So we have to sort of deal with two interregnums, one related to the tariff, another related to fiscal policy. And so it's very difficult to look through all of this noise. But I think when one does, we find that the economy is in a much more frail condition than is generally understood. And I would cite two hard indicators of that. Number one is the ratio of job openings to unemployed, known as the Beveridge ratio. And it has dropped very precipitously from the peak levels, but more importantly, it's below where we were prior to the pandemic. And this is an indication that the labor markets are tightening more significantly than is generally understood. Another hard indicator is what's happening to the rate of increase in average hourly earnings. You can measure economic activity or the strength of economic demand by quantity measures, or you can measure them by price measure. Well, wages is a price measure. And here, the evidence is entirely unequivocally weak. And we saw this weakness in April. We had only a 0.2 rise in average hourly earnings. Now, 1 month doesn't to be overestimated, but we have to remember at the peak, the year-over-year increase in early 2022 in average hourly earnings was 6%. And now in the latest 12 months, we're down to 3.75%. And that, to me, is significant development and indicative of the fact that the labor markets are much weaker than people generally believe. So I would add one other minor little problem, and I don't like to get down in the weeds, but the economic statisticians have a great deal of problem always, in the best of circumstances, seasonally adjusting economic data. And one of the things that they never do a good job of is when Easter, which is a floating holiday, comes really early or really late. And this year we had an extremely late Easter. And that comes here at a time where we're trying to sort through the impact of the cutback in federal spending, which occurs with a lag, especially with regard to employment. It looks like that the DOGE efforts have cut federal employment by about 200,000, but that doesn't mean they go off the payrolls immediately. They go off the payrolls rather gradually. And so we have to sort through all of this noise, and at the same time, there are the problems of trying to properly seasonally adjust when Easter occurs quite late. But I think once we get past this noise, the economy is going to show much weaker than people generally believe, and that we will have a recession. Well, first of all, with regard to tariffs, and if you talk about the micro demand curve, you have to remember that the law of demand means that as prices go higher, demand goes down. So you have a downward sloping demand curve. As prices go up, if you're a producer, you will offer more. So when you have an increase in tariffs, the supply curve shifts inward toward the origin and toward the left axis, the price axis. And so when that happens, the price level rises, but the quantity demanded and supply goes down. But the supply curve shifts up, it lifts up and shifts inward. So what happens as a consequence of this? Well, to answer that question, you have to understand how sensitive internationally traded goods are to price changes. And most goods in international trade are what economists call price elastic. In other words, if the price goes up, there will be a greater than proportional decline in quantity demanded. So price goes up, quantity demanded comes down, but quantity demanded falls faster than the price increase, and price times quantity is total revenues. So that happens to the country that is raising the tariffs, and when there is reciprocation, the same thing happens all around the globe. And so for your firms engaged in international trade, their total revenues go down. Well, total revenues determine the demand for the factors of production. And the factors of production are natural resources, labor, capital, and they cut the demand for these factors of production. And so as the supply curve is shifting inward, these events occur fairly rapidly. Prices go up, quantity demanded goes down, total revenues go down, and the demand for the factors of production goes down. But in terms of the way in which we capture this in the economic data, the process is probably going to be slower than what's actually happening in the real world. Makes it very difficult to sort through. Now, if you go back and look at the period from the 1920s to the start of World War II, there are a lot of important generalizations that we can use. The major European economies were considerably weakened by World War I. This was particularly true for England and France and Germany, of course, because the war had been centered there. So when World War I started, the major European countries went off the gold standard. And so the issue was trying to return to the gold standard. And the French were to do so. They did this in 1925, and they did something that was very beneficial to them but hurtful to the rest of the world. They set the new value of the French franc considerably below where it had been. In other words, they massively devalued the French franc. Now, the British and anyone that was interested in the matter realized that this was going to benefit France at everyone else's expense. But they let France do it. After all, France had been mutilated by the French warfare and the casualties and the damage. And so France started running a trade surplus. And France at that time was a major producer of agricultural goods and industrial goods, which meant that they were then able to steal output from the rest of the world. It's basically the same effect as a tariff. And so as the repercussion of the French devaluation in 1925 took effect, it eventually led to other devaluations. In the late 20s, the Dutch East Indies, which is now Indonesia, devalued. And then Australia devalued. And then there were multiple devaluations in Latin America. The British returned to the gold standard in a move that was quite harmful to them they returned at the pre-war level of the pound, which meant the British pound was overvalued. And so there were all kinds of stresses in the United Kingdom. And so the United States, as a result of the actions that were occurring around the world, we were beginning to run large trade deficits. And we retaliated by something called the Smoot-Hawley tariff in 1930. We didn't go off the gold standard, or we didn't devalue in terms of gold, but we took another action that falls under the category of beggar thy neighbor. Well, it really doesn't matter whether you devalue or whether you raise tariffs or impose capital controls. They're all going to interfere with the flow of international goods and capital, which are the reciprocal of each other. And so after we did this, the Smoot-Hawley tariff, there were another whole round of currency devaluations. And in 1931, the British devalued. And then we eventually retaliated again in 1933. And I don't remember the exact number of devaluations against gold that occurred, but from the French devaluation to our devaluation in 1933, I think it was approximately 30. In other words, one retaliatory action then beget more, and the whole process reduced demand, and it was rather deflationary, not inflationary. We don't want to go down that road. Monetary policy comes to play and has an important role. And we showed a chart in our letter that of the trend-adjusted real M2, which we have going back to the founding of the first year of the Fed's operation in 1914. And we like to use a 4-year moving average because that's the general lead time between the deceleration in detrended M2 and the start of a recession. And if you look at that chart, or if you do that calculation yourself, what you'll see is that we now have the 9th instance since 1914 where real detrended growth over the last 4 years is negative. And the second instance was really the 1920s and 1930s. And so the mistake that the Federal Reserve made then, and for which they were greatly excoriated by Milton Friedman and also Ben Bernanke, was that they didn't reverse the decline in money supply. And then that exacerbated this downward spiral. And right now, on a real detrended basis, over the last 4 years, M2 is declining again. I might point out, before we leave the subject, that all of this buying in advance of the tariffs not only did it lift imports and inventories and possibly hiring and consumer spending and a whole host of other things temporarily, it also had some impact on the balance sheet of the commercial banks, the deposit creators, because people to finance the buying of imports have to go to the banks for loans, and this increases loans and deposits. I think that part of the smoke here is that the tariffs impacted the bank balance sheet and money supply, but that will reverse out. And what we're going to find is that this little blip that we've seen in M2, which really hasn't changed very much, the 4-year average, will reverse. And so I think that monetary policy is too restrictive and that it will not be possible to bring forth a recovery in economic activity in 2026 unless the Fed reverses. And so one of the problems for all of us is that all this smoke and the concern temporarily over inflation puts the Federal Reserve on hold. And because they use this ruse of data dependency, which I think is a flawed concept, because the data is often subject to revisions, all kinds of one-off distortions. The GDP numbers have been revised downward last year. The payroll numbers, which you had a bigger reaction to today, it's literally one of the worst series for revisions. There's been a consistent overshoot between the payroll jobs and the quarterly census of employment and wages. And yet we react to it every month as if it's meaningful. We really don't know that. And one of the things that I know is a small technical matter, but the birth-death model, which picks up the small firms, actually added in about 10,000 more jobs this April than it did a year ago, even though this April had the benefit of Easter, which may have been worth a 30 or 40,000 miss. I mean, these kinds of distortions occur all the time. Some of them are very technical, but the whole process of relying on this data is not a good approach, but that's where the Fed is centered. And so it delays them taking a bigger picture and understanding that they have to look and try to evaluate the economy on its fundamentals rather than relying on so-called data dependency.